Hello and welcome to this video for Fortune and Freedom. About a year ago, John Butler came on to a video just like this one and he predicted that inflation was about to soar. Well, let's just say that he's been proven right in spectacular fashion since, and so of course we've invited him back. In fact, he's been on often to discuss other issues, but we've invited him back to discuss this particular one, this issue of inflation, to talk about what he expects to happen next. But before that, let's go into the context. John, can you explain where inflation has hit since I think we've had a whole blizzard of inflationary data in the last few weeks?
Yes, we've had some fresh data, which has generally surprised to the upside just about everywhere. In the euro area now, inflation is over 5%, which is a very big surprise. Markets were looking for something nearly a full percentage point lower than that. So that's a huge miss. In the UK, inflation has risen to over 6% year on year, with the Bank of England openly admitting it's going to be up at least another full percentage point over the coming couple of months. And then in the US, inflation is over 7% year over year, which is just an astonishingly large number when you think about where it started from just 2 years ago, very close to zero. That's a larger, faster rise than we saw at any point during the 1970s.
The reason we decided to have this video when you and I were discussing what to talk about was the idea that central banks are becoming increasingly desperate, chaotic, bizarre, whatever you want to call it. And that's what we're going to focus on. But before, I think I want to give a little bit more context, because what's happened is really quite extraordinary. We've got the Bank of England admitting that inflation was likely to peak at 7.25%. It is in April. That's their new expectation, which is triple the Bank of England's 2% target, more than triple. But what makes me laugh about this is that they've said in their press conferences, and I'll read a quote here from the Telegraph, stressing its inflation-fighting mandate, the Bank of England said that the remit is clear. The inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. Meanwhile, they're raising interest rates at 0.25%. These guys are nuts.
Well, let's face it, there was a big dissent, right? 4 members were asking for a 50 basis point rise. So you're right, the majority chose not to do that, probably fearful of what it might do to the fragile UK financial markets and financial system. So at least there maybe are a handful of voices of sanity on the committee, but they are in the minority. And obviously, what you've seen so far in other economies, the euro area and the US being the ones I've mentioned, it's just baby steps all around so far, notwithstanding generationally high rates of inflation, miles above official targets.
But inflation's not taking baby steps. And so if the primacy of the inflation target and price stability and the price target applies at all times, then there would be, even a 1% increase. If they're expecting inflation to increase more than 1%, by April, then a 1% increase in interest rates would be like a reasonable start, wouldn't it?
Look, saying one thing and doing another is a pretty universal thing that one does when you're in a position of authority and things are not going as planned. That's just, politicians do it, and increasingly central bankers are doing it.
Well said. I think it's worth mentioning the same is playing out at the Federal Reserve, where they've got I've got a quote here. I better check who it's from Bloomberg, that traders are expecting the Fed will end the cycle with the policy rate at about 1.65%, and the long-term inflation expectations anchored around 2%. So that means they're pricing in continued negative real interest rates, continued inflation above interest rates. That's, again, an absurd sort of scenario to forecast as an equilibrium.
It is absurd according to any understanding of monetary economics and the relationship that has with the price level. It goes against even the basic economic conventional mainstream. Now, that mainstream, of course, has been consistently wrong about lots of things in recent years. But even if you're speaking to that audience, even they've got to be shaking their heads at this point. You just can't make those numbers work. No one in their right mind believes that a sustained period of negative real interest rates results in declining rates of inflation over time. There is nothing, zero, in the economics profession that concludes that that could possibly be the expected result.
And history provides a great bit of context for that argument. The idea that the last time inflation was this high was the early 80s, and it took 21% interest rates to get inflation under control back then. That's the sort of interest rate which we should be talking about, not these 0.25% increases. There's one more mention of the Bank of England's decision, which we should get to, which is the fact that at this level of interest rates, they will supposedly begin winding back QE policies, which means they're not just targeting interest rates, they're going to reduce how many assets they buy on the market. Do you think that is going to be an important shift?
Well, in a way, the two go together. Now, let set aside QE for a moment. When a central bank increases interest rates, they're raising the cost of borrowing money, which of course is also the benefit of saving money. And that has the net result of reducing the so-called money multiplier, which is what is related to loan origination and asset origination in the first place, meaning there is simply less stuff circulating for the bank, the central bank in this case, to need to absorb in the first place. So the higher interest rates go, the less relevant any concept of QE becomes. You're targeting interest rates rather than the size of your balance sheet. And the balance sheet will naturally adjust to reflect that new level of interest rates. It's only when you get to a very, very low level of interest rates, or zero or outright negative, that you have to deliberately grow your balance sheet above and beyond what that a very low level of interest rates would imply. So you go out into the market as a matter of policy, buying even more to try and basically to take assets off bank balance sheets to encourage them to make more loans. So it is only natural that if the Bank of England is planning on continuing to raise interest rates, that they would expect less need for QE anyway. I think perhaps why they're offering this explanation is because they're trying to suggest to the banking system, to financial markets generally, that they are going to begin pursuing what you might call a full-scale, full-spectrum normalization, not just trying to get interest rates higher, but winding back any explicit QE that was related to a very, very low interest rate policy.
There's a central bank out there that was very adamant that they were not going to normalize anytime soon, but it looks like inflation has forced their hand. Can you give us an update on, I think there was a banking analyst who said it was a backward roll on monetary policy.
Yes, I think the ECB is really in a bind now, because not only are they in this very, very challenging situation of inflation having surged way beyond their expectations, or those of the markets for that matter, but to a level which is really, really divisive when you look at the structure of the euro area, and the fact that 5% plus rates of inflation are neither here nor there in the history of, say, Italy and France and Spain, but in modern German history. I think you have to look at extremely brief and rare occasions to have seen German CPI get above 5%. I think it did happen briefly in the oil shocks of the 70s and early 80s, and I think it did happen briefly in the reunification of Eastern Germany. But that, of course, was also seen as a truly exceptional development of historic importance for the German people, where maybe you let it slide a little bit. This is different. This is different. Germans look at that number with absolute horror, and that's going to have political ramifications for domestic policies in Germany, as well as, of course, the German position on what the ECB is planning to do going forward. Because as it seems now, the ECB is suggesting they're actually very, very comfortable with this state of affairs, and implicitly, they're not going to do anything about it.
Your two examples, I must object. The reason the inflation only spiked so briefly in Germany during those two times was because the Bundesbank raised interest rates. And I'm not talking about 0.25% here. They did it properly. And that's why the German Bundesbank had the reputation that it did, because it was this moment of reunification. And all the politicians said, we should just let this slide. It's just a bit of inflation because of reunification. And the Bundesbank said, no, the price, as the Bank of England is saying now, the price stability is always it always applies, and that's the mandate. And so they raised rates, and yeah, even for reunification, they were not willing to budge on what was their legal mandate.
Well, very famously, Karl Otto Pohl, who was in charge of the Bundesbank at the time, I mean, he was very open about it. He would say in public that, look, the government can go ahead and fund all of this largesse to rebuild Eastern Germany. It's our job to make sure that that does not become generally highly sustainably inflationary. And so he raised short-term interest rates to very high levels, which threw the German yield curve into deep, deep inversion, which of course would normally signal a recession ahead. But because of the extraordinarily expansionary fiscal policies that the government was following at the time to rebuild Eastern Germany, actually, it simply helped to maintain price stability alongside that very aggressively expansionary fiscal policy. In other words, as you say, the Bundesbank did its job. And to its credit, right, to its historical credit, it demonstrated that sacred independence that was enshrined in the Bundesbank Charter, part of the German Basic Law following the Second World War.
And that's why they can't seem to get German central bankers to stay around for long at the ECB. Let's move on to this twist that's happened in financial markets over the last few, I would say, weeks, probably perhaps months, where central bankers went from being the key force or guarantor that financial markets would keep ticking over and keep going up and everything would be wonderful. Even a pandemic isn't really a big problem for long because the central bankers will do whatever it takes. Now, all of a sudden, they're the source of all the pain and the problems, and everyone's panicking about what central bankers are going to do. And I find that swap immensely amusing, and I wonder if you've noticed it too.
Well, look, I mean, there's that old saying, take care for what you pray, the gods may one day grant it to you. And, central banks told us for years they were desperate to try and get inflation levels higher again. And therefore, they assumed all of these unconventional powers and policies to themselves to try and bring that about. Well, lo and behold, here you've created this beast, this Frankenstein. Now, what are you going to do about it? It's not a nice problem to have. An analogy that I think I mentioned to you once before is that it's really been a delicate balancing act, trying to maintain some credibility while nevertheless trying to jumpstart their economies and get inflation rates higher, and trying to prevent any further contribution to financial instability as a result of all this liquidity sloshing around. And so that's like walking a tightrope. But to mix metaphors again, what's really happened though is they backed themselves into a corner. So they've been walking backwards on a tightrope into a corner, and nobody wants to be stuck in that position.
Yeah, it is ironic what's happened. However, there is a solution. And this made me laugh a lot. So I want to read a quote here. It's from Michael Every of Rabobank, who's a very interesting economist and analyst, who's well worth watching on any interviews or reading any of his work. I highly recommend him. And this quote, it's fascinating. It goes to what you said earlier about the fact that the Bank of England at some point has to reduce its QE if it's going to raise interest rates. The quote is, "Why can't they raise rates and pump markets? If secretly selling puts holds up stocks, and you can do that and raise Fed funds to pretend you're serious about supply-side inflation you can't control, then why not? Similarly, why can't you raise rates and do QE? Yes, they run in opposite directions on yields, but if you want to finance a huge budget deficit while cooling the heels of the rest of the economy, buy freshly issued government bonds with higher coupons flowing back to the Treasury to boot and raise rates." That's sort of what the Bank of England's doing here, or was up until recently, where it raised interest rates but continued QE. The underlying idea here is that you can raise interest rates to make it look like, oh, we're worried about inflation, we're going to tighten monetary policy. Meanwhile, you can just keep basically financing governments and companies and mortgage borrowers to some extent, and keep the whole thing going, right?
Well, yes and no, because see what happens now when you start to micromanage things in this way, and we've seen examples of this before. It's not just QE. We've seen things like so-called Operation Twist, and we've seen central banks buy non-government assets as ways to try and more directly stimulate other sectors of the economy, and so on and so forth. These sorts of central bank gymnastics have been getting more and more convoluted for years now. And now Michael Avery is just saying, well, hey guys, why stop there? Maybe there's even more we can do here. But in the same way, a criminal trying to cover up evidence of their crime when the investigators are hot on the trail, they start to do increasingly bizarre things to cover up those crimes, including committing more crimes. That in this case, central banks perhaps distorting markets even more, perhaps creating bizarre distributional effects that favor some parts of the financial system over other parts of the financial system, that favor the financials over households, that favor the government over financials, that favor, who knows? The fact is, though, is that the road to hell is laid with good intentions. They may claim that they're getting into this hyper micro management and manipulation of financial markets with some reasonable policy goal in mind, but it becomes increasingly difficult to have confidence that they even truly know what they're doing anymore.
Yeah, it's and they're already getting blamed for whenever anything goes down, it immediately becomes about the fear of tighter monetary
Look,
policy.
right. Look, when you're the dominant actor in any scenario, you're going to have responsibility for what happens. For example, the United States military sometimes gets a lot of flack for a lot of friendly fire casualties on the battlefield. Well, when you're the one with 95% of the weapons and doing 95% of the shooting, you're going to cause most of the friendly fire incidents, no matter how good you are. And I think central banks deserve all of the criticism they're getting for flailing about and potentially causing more fresh problems to solve every time they manage to solve an old one, just like Heracles fighting the Hydra.
I'm not familiar with Heracles fighting the Hydra, but the part of the analogy before that, the key message is don't be there in the first place with your soldiers. But when you talked about the central bank gymnastics, this headline from the BBC seems to fit the bill. It's a quote: "Workers should not ask for big pay rises to try and stop prices rising out of control," the Bank of England governor has told the BBC. Now, I'm laughing because this is a serious issue. Quite frankly, a lot of people out there are going to be in trouble, but I can't stop laughing because it's just so absurd. Telling people not to ask for pay increases when you've just triggered what is going to be 7.25% inflation according to your own expectations. What?
Well, look, this is a classic emperor has no clothes sort of moment, isn't it? Right? Because the fact is that clearly central banks bear some degree of the responsibility for what's happening here. Now, you could argue that numerous other policies, fiscal and lockdown and everything else, have played a role, but central banks cannot deny that they've also played a role here. And so now, the chickens are coming home to roost, and workers are saying, well, hey, I see my cost of living getting squeezed here, not only in energy prices, it's showing up almost everywhere now. And so, of course, I'm going to demand higher wages. How else am I going to feed my family, heat my home, reasonably maintain my standard of living? And for the central bank to come out and say, oh, but don't do that. It's almost an admission of guilt in a way. And hopefully the general public is going to start to wake up and realize that this monetary policy regime that we've been following is not fit for purpose.
I think the idea that, well, basically you can't vote for your central banker. So the blame's going to go to the political side of things. And in the Eurozone, that's especially interesting. But I'm looking here at an image that was posted on the Telegraph's homepage or in the article. And it's one of the funniest things I've seen in a long time. We probably can't show it to you because of copyright, but I'll describe it anyway. It's a picture of the Chancellor Rishi Sunak sort of pointing politely, and that's overlaid with a chart of energy prices, the average energy bill over time. And it sort of ticks along sideways. There's no x-axis, as journalists probably like to do. There's no x-axis, sort of the price of energy, and the energy bill tags along sideways. And then there's a point at which the price cap is introduced on energy prices, and then it ticks along sideways for a little bit more, and then it absolutely skyrockets. And we've all seen the news recently with this repricing of energy. Ever since this price cap was introduced, it was always going to happen. I'm from the government, I'm here to help. Sure enough, boom goes the cost of energy. I think we're going to be seeing a lot of things like this, and the demands to not increase wages. We had the energy companies around the UK telling people to do all sorts of weird and wonderful things to try and keep warm because people can't afford the price of energy. This inflation that's been caused by central banks or the supply chain crisis is going to start to hit politics pretty soon. How hard is it going to hit?
I think it will ultimately hit at least as hard as it did in the late 70s and early 80s. At least that's my view here. And some people might think that's a little bit extreme. I don't think it is. If you look at the stagnation of real incomes, that is incomes adjusted for inflation, if you look at the rise in the Gini coefficients, that is a measure of wealth inequality, those are higher now than they were in the late 70s and early 80s. That is, the growth of real incomes going into that period was actually very strong, whereas in recent years, the growth of real incomes has not been great. So I actually think we're working our way up into something which is going to have even greater political implications. Now, that said, I have no magic ball, and I can't see into it and know precisely how long and in what form that's going to begin to manifest itself. But the idea that there's not going to be some politician at some point campaigning on a platform where the number one campaign issue is get inflation down no matter what, it's coming. And when that happens, and it looks like that person and their party are going to assume power, the stock market had better watch out, because that's going to be a very frightening time for financial assets.
And perhaps we're already seeing that change happen in the Tory party with some people worrying about this net zero promise and whether or not the cost of living should be prioritized ahead of that net zero promise.
Well, this is also related to the energy cap, believe it or not. So, I mean, look, there's a long history of price controls having a really, really bad outcome in the end. You don't see it straight away, but after a few years of suppressing prices, what you've actually done, of course, is suppressed investment in future capacity by doing so. And then you don't have the capacity you need when there is a surge in demand, or when there are supply and structural issues that suddenly arise in that market as a result of underinvestment. Well, guess what's happening? The UK has raced ahead towards relatively unreliable sources of energy and has not invested in the more reliable forms of base power that are needed to provide relatively affordable energy in all reasonable conditions. And so look what happens, right? Look what happens. And so we're getting this big price spike for a variety of reasons, but the cap itself is one of the causes. And yet the government will never admit that.
Yeah, it's very simple economics, isn't it? But it's not just energy. I've got here a quote from the Express about an ONS study where they asked a bunch of households, almost 4,500 households, what was the cause, the key cause behind their cost of living increase. And actually, it was food. It was food that came out on top of energy. So I feel like this cost of, I mean, there's this famous quote, I can't remember who it's attributed to, that, people will put up with anything until they can't afford to put dinner on the table for their family, and then they go berserk. And if it's food that's leading energy, then we may well be quite close to that point. Let's get to what I think is the key question here for people who are trying to predict inflation over the next few months. Although it's possible that the supply chain crisis will persist and that will continue to cause what's referred to as supply push inflation, cost push inflation, have we seen the monetary version of inflation hit yet? In other words, has the increase in the money supply and potentially the increase in velocity, has that part of inflation, the monetary side, really hit yet? Or have we only had the supply chain crisis so far?
Well, look, the supply chain crisis happened in a context of velocity being, extremely historically low. What we can already see is that it has stopped declining. Whether it is really going to now sustainably increase, as you say, the jury is still out. Now, I think it likely will, but it has certainly stopped declining. So, in other words, what was kind of a disinflationary tailwind that was able to offset perhaps the early stages of the supply crisis is no longer there. It's not a tailwind. At best, it's neutral. And indeed, it might be turning into a headwind, which is simply going to reverse that disinflation. And of course, what is a headwind for disinflation is a tailwind for inflation. So I think that this is going to remain the case for a while. Now, that said, if you look at producer prices, they are beginning to roll over a bit. So some of the pipeline pressure is beginning to ease a little bit, but it's very early days. And we're looking at probably at least another full year of historically elevated consumer rates of inflation before anyone can begin to say, oh, gee, that was transitory. But of course, when they were saying transitory early on, they were talking months, not years. We're going to be in this for at least a full 2 years because, of course, this started a year ago. And I just said we've got at least another year ahead of us.
One of the things that interests me, which made me predict inflation to spike, was that the velocity of money fell so much during the pandemic that you can expect some sort of recovery back to more normal levels. And that combined with the amount of QE and money printing and money creation would lead to an extremely high rate of inflation. And the counter argument is, oh, they'll just unwind the QE. And I think what we're seeing right now is that they cannot unwind the QE without causing all sorts of instability in financial markets, which means that possibility of a spike in velocity bringing the money printing that has happened over the last 2 years into action and making it flow through the economy, that really could deliver a monetary version of inflation shock on top of this supply chain crisis. That's what I'm really worried about. I don't know what sort of probability you would assign to that.
Well, look, I think we're seeing some of that in the mix already. I'm just saying that I think there's potential for more of it to be cut to get into the mix. And yes, even as supply chains begin to clear, you're just going to have this excess liquidity continuing to find its way into the system. But yes, as you also say, central banks will find it difficult to offset that, even if they want to, because the fact is their respective financial systems are financing huge amounts of basically leveraged legacy debt positions via low rates at the central bank, taking advantage of those large central bank balance sheets and the low borrowing costs they imply for everyone. You can't unwind that without causing at least a small financial crisis. You can't. I mean, I think it's just maths at that point. Someone's going to have to pay. If you really are going to rein this in, the financial system is going to take a huge hit. And what are you going to do about that? It's not a situation any central bank would want to be in, but they really have backed themselves into these corners.
Yeah, I think this situation can be summed up as either inflation gets out of control or we're going to have another financial crisis before inflation gets out of control. John, thanks very much for joining me, and everyone at home for watching. Thanks very much as well.